When most income investors think about building a diversified portfolio of monthly income streams, they think about equity-covered call funds on the S&P 500 and Nasdaq-100, maybe some bond exposure, perhaps a real estate investment trust or two, and increasingly some Bitcoin income exposure. What almost nobody thinks about is master limited partnerships MLPs, and that collective blind spot is part of what makes the NEOS MLPI ETF worth spending serious time on today. Quick disclaimer before we get into anything, nothing in this video is financial, investment, or tax advice. I'm not a financial advisor. Everything here is purely for educational purposes. Please always do your own research and consult a qualified professional before making any investment decisions. Master limited partnerships are not new. They have been investable for decades, primarily through investors in the southern United States who have long been familiar with the energy industry and the specific business structures that dominate oil and gas infrastructure. But for most income investors who came to the space through dividend stocks or covered call ETFs, MLPs are genuinely unfamiliar territory. So let's start from the beginning and build up to why the NEOS version of MLP exposure is worth understanding. An MLP, a master limited partnership, is a business structure commonly used in the energy sector for companies involved in the transportation, storage, and processing of oil, natural gas, and related commodities. These are not primarily exploration and production companies making bets on finding new oil wells. They are infrastructure businesses, the pipelines, the storage terminals, the refineries, the processing facilities that sit between where energy is produced and where it is consumed. Think of them as the toll roads of the energy economy. The commodity price moves around them, but the fees they collect for using the infrastructure are often contractually fixed or tied to volume rather than commodity price, which gives their cash flows a degree of stability that pure oil and gas producers do not have. The reason MLPs have historically attracted income investors is simple. They are structured to pass through an enormous percentage of their cash flows directly to investors. The typical MLP in the current market is distributing approximately 6 to 8% of its value annually to its investors. That is a meaningfully higher starting yield than most equity dividend stocks, most dividend ETFs, and even most real estate investment trusts. And many of those distributions historically carry a return of capital component, meaning a portion of the income received is classified as a return of your own cost basis rather than ordinary income, which defers taxes rather than triggering them in the year received. For income investors thinking carefully about tax efficiency, the inherent return of capital treatment within MLP distributions is a genuine structural advantage. However, MLPs have traditionally come with a significant operational headache for individual investors. When you invest directly in an MLP, you typically receive a K-1 tax form rather than a standard 1099 at year-end. The K-1 is not complicated in concept. It tells you your share of the partnership's income, deductions, and credits, but it is burdensome in practice. K-1s arrive later than 1099s, sometimes as late as March or even April, which delays your ability to file taxes. They require additional schedules on your tax return. If you hold MLPs in multiple partnerships, the administrative work multiplies. For many retail investors and even some financial advisors, the K-1 complexity is enough to discourage MLP investment entirely. MLPI eliminates this problem by wrapping MLP exposure inside a 40 Act ETF structure. Inside the ETF wrapper, all the K-1 tax reporting happens at the fund level rather than flowing through to individual investors. What investors receive at year-end is a standard 1099, the same form they receive from every other ETF or stock in their portfolio. The K-1 headache disappears entirely. This alone is a meaningful quality of life improvement for MLP investors that deserves recognition independent of any other feature of the fund. Now let's talk about the structure of the fund itself, because there is a specific regulatory detail that shapes what MLPI actually holds that investors need to understand clearly. Under the rules that govern 40 Act ETFs, the legal framework that covers most ETFs available to retail investors, a fund cannot hold more than 25% of its portfolio directly in master limited partnerships. This is a hard regulatory ceiling, not a choice that NEOS made. The reason the limit exists is related to tax treatment at the fund level, but the practical implication for investors is that MLPI cannot be a pure MLP fund even if it wanted to be one. NEOS works around this constraint by filling the remaining approximately 75% of the portfolio with companies that are highly correlated to the MLP space, without technically being MLPs, companies involved in energy infrastructure, delivery, refinery operations, and all the various components of the oil and energy production and distribution ecosystem. The index the fund tracks, developed in partnership with a third-party index provider called MQ, holds between approximately 24 and 32 names at any given time, all of which must derive their revenues primarily from energy production, transportation, or refinement activities, and must be domiciled in the United States or Canada. Every holding in the index is capped at a 10% maximum weight, and weighting within those constraints is driven by market capitalization. The result is a portfolio that behaves like MLP exposure in terms of its income characteristics and its correlation to the energy infrastructure sector, while technically meeting the 40 Act holding requirements through the correlated industry complement. On top of this underlying portfolio of energy infrastructure companies, NEOS runs its covered call income engine. The approach here is consistent with the philosophy across the entire NEOS product lineup. Sell call options out of the money on less than 100% of the portfolio's notional value, collect the premium, distribute it monthly, and preserve meaningful upside participation for the underlying holdings. The specific options used are AMLP options on the Illyrian MLP ETF, rather than the S&P or Nasdaq index options used in funds like SPYI and QQQI. This is a practical constraint driven by the available options market for MLP-related exposure rather than a strategic preference, but it works well for the fund's purposes given AMLP's high correlation to the underlying MLP and energy infrastructure holdings. The target distribution rate for MLPI is 14 to 16% annualized. The current distribution rate sits at approximately 14.76%, right in the middle of that target range. To understand where that yield comes from, you need to add up the two sources. The underlying MLP and energy infrastructure holdings are themselves distributing approximately 6 to 8% annually to the fund. The covered call overlay on top contributes the remaining premium income to reach the 14 to 16% target. The result is a fund where the baseline income comes from genuinely cash-flowing energy infrastructure businesses, real companies with real toll road economics collecting real fees from energy producers, and the options overlay approximately doubles that baseline yield. The energy sector's natural volatility is not a bug for this strategy, it is a feature. Covered call premium is a function of implied volatility. The higher the volatility of the underlying asset, the more expensive the options are and the more premium a seller collects. Energy infrastructure stocks move meaningfully with oil prices, geopolitical developments, supply and demand shifts, and the ongoing oscillation between fossil fuels and emerging energy sources. That volatility, which can make MLP investing uncomfortable for investors who focus primarily on price charts, is precisely what makes the options overlay more productive for MLPI than a covered call strategy on a less volatile asset class would be. NEOS is harvesting that energy sector volatility and converting it into monthly income, while the partial coverage approach selling calls on less than 100% of notional preserves meaningful upside participation when energy infrastructure companies rally. The distribution consistency that MLPI has demonstrated since its December 2025 launch is intentional rather than coincidental. Every fund in the NEOS lineup is engineered with a distribution target calibrated to the natural volatility of its underlying assets. For MLPI's energy infrastructure underlying, the volatility profile supports a sustainable 14 to 16% target even in lower volatility market environments, which is the stress case NEOS uses when setting distribution targets. The worst-case scenario for any covered call income fund is a sustained period of extremely low implied volatility, where options become cheap and premium income compresses. By setting targets against that stress scenario rather than against average or favorable conditions, NEOS builds in a margin of safety that allows consistent distribution payments across varied market environments. The result for investors is a monthly check that arrives with a degree of reliability that actively managed or discretionary income products often cannot match. On the performance side, even in the roughly 6 months since launch, MLPI has performed well on a total return basis relative to the available benchmarks in the MLP space, including AMLP, the Illyrian MLP ETF, which is the most widely held MLP fund, and which also serves as the source of the options overlay. Total return on a 6-month track record is obviously too short to draw strong conclusions, but the early data is consistent with the design intent. The underlying energy infrastructure holdings have contributed NAV stability in their own distributions, and the covered call overlay has contributed the incremental premium income that brings the total yield toward the 14 to 16% target range. The NAV has held up well during a period when energy markets have shown their characteristic volatility, which is meaningful validation for the partial coverage approach that preserves upside while generating income. The tax structure of MLPI is different from SPYI, QQQI, and the rest of the NEOS core equity lineup in one important way, and investors should understand this distinction clearly. The NEOS equity funds use S&P 500 or Nasdaq-100 index options, specifically SPX and NDX options, which are Section 1256 contracts. Section 1256 contracts receive favorable 60/40 tax treatment regardless of how long the position is held. 60% of gains are taxed at long-term capital gains rates and 40% at short-term rates. This is one of the most consistently cited tax advantages of the NEOS equity funds and a meaningful benefit for investors in taxable accounts. MLPI cannot access this advantage because there are no 1256 contract index options available for MLP exposure. The AMLP options used in MLPI are equity options on an ETF rather than index options, and they do not receive Section 1256 treatment. However, MLPI has its own distinct tax efficiency mechanisms that partially compensate for the absence of 1256 treatment. The first is the inherent return of capital component that comes from the underlying MLP holdings themselves. MLPs routinely classify a portion of their distributions as return of capital for tax purposes, and that treatment flows through the fund to investors as a reduction in cost basis rather than taxable income in the year received. The second mechanism is loss harvesting from the options overlay. When NEOS sells covered calls and then buys them back at a loss to roll the position, those harvested losses can be used to reclassify distributions as return of capital at the fund level. In a strong market environment where the underlying energy infrastructure stocks are rising, the options that were sold out of the money often expire with gains, but NEOS actively manages the rolling process to generate losses that offset income, increasing the return of capital component of distributions and deferring taxable income for investors. The combined effect is that MLPI is designed to produce as high a return of capital percentage as possible on its distributions, even without the 1256 advantage available to the equity funds. For investors thinking about where MLPI belongs in a portfolio that already includes SPYI, QQQI, or other NEOS products, the case for inclusion is primarily about income source diversification. SPYI and QQQI derive their income from S&P 500 and Nasdaq-100 option premium income that is correlated to equity market volatility. BTCI derives its income from Bitcoin option premium income correlated to cryptocurrency volatility. MLPI derives its income from the combination of energy infrastructure cash flows and energy sector option premium, a materially different income source that responds to different economic drivers. Oil prices, energy demand, geopolitical developments in energy-producing regions, and the structural economics of energy infrastructure are not the same forces that drive S&P 500 implied volatility or Nasdaq-100 tech sentiment. Adding MLPI to a portfolio that is otherwise concentrated in equity-covered call income provides a genuine diversification benefit at the income source level, not just at the asset level. For investors who are already invested directly in individual MLPs and are familiar with the space, MLPI offers three specific improvements over direct MLP ownership. The first is the 1099 versus K1 simplification we discussed at the outset, a genuine operational improvement that is easy to undervalue until you have dealt with K1 season. The second is the diversification across 24 to 32 names versus the concentration risk of owning one or a handful of individual MLPs. Individual MLPs can experience significant price dislocations from company-specific events, mergers, operational problems, contract renegotiations, regulatory changes that a diversified portfolio of energy infrastructure companies absorbs without catastrophic impact. The third improvement is the covered call overlay that approximately doubles the distribution rate from the 6 to 8% range that the underlying MLPs deliver on their own to the 14 to 16% target. For income investors who specifically want maximum cash flow from their energy infrastructure allocation, the covered call enhancement is a meaningful and direct improvement over holding the underlying MLPs without any overlay. For investors who are entirely new to the MLP space and given the demographics of income investing, that is probably a significant portion of the people watching this. The most important thing to understand is the volatility profile. Energy infrastructure is not a smooth, low volatility asset class. Oil prices swing meaningfully. Geopolitical events, conflicts in energy-producing regions, sanctions, supply decisions by major oil producers create sharp moves in energy-related equities. Individual companies within the energy infrastructure space merge, restructure, and occasionally face serious operational or financial challenges. The MLPI ETF structure mitigates single company risk through diversification, and the covered call overlay converts some of that volatility into income. But the price chart of MLPI will not look like a money market fund. There will be periods where the fund's NAV moves meaningfully with energy market conditions. Investors who are not comfortable seeing meaningful price fluctuation in a position should size their MLPI allocation accordingly. The 68 basis point expense ratio for MLPI is in line with the broader NEOS product lineup and reflects what investors are getting. active oversight of the options overlay, professional management of the covered call strategy through multiple market environments. The operational infrastructure required to run a 40-act ETF with a complex underlying including direct MLP holdings, correlated industry positions, and an active options program, and the accumulated decade-plus of options portfolio management expertise that NEOS brings to every product it manages. All performance figures for MLPI are presented net of this fee, so the returns you see on the NEOS website already reflect the cost of running the fund. The broadest context for MLPI within the income investing landscape is that it represents something genuinely scarce. A monthly income ETF specifically built for the energy infrastructure and MLP space, using a covered call overlay to enhance an already high baseline yield, wrapped in a 1099 reporting structure that eliminates the primary operational friction that has historically kept many investors away from direct MLP ownership. As of now, NEOS believes there is no direct competitor offering the same combination of MLP correlated income exposure, covered call enhancement, and ETF wrapper convenience in a single product. Whether that claim holds as the income ETF space continues to expand rapidly is worth watching. But for now, MLPI is addressing a specific investor need in a specific way that the existing MLP fund landscape was not addressing. At Dividend Desk, we make it our business to cover every meaningful corner of the income investing world, including the corners that do not get the same attention as the high-profile equity income funds. MLPI is a genuinely interesting addition to the NEOS lineup that deserves serious consideration from income investors who want to diversify their monthly income sources beyond the standard equity and bond categories. Whether it belongs in your portfolio depends on your comfort with energy sector volatility, your existing income diversification, and your tax situation. Do your research, understand what you are owning, and make the decision that fits your specific circumstances. If this breakdown was useful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community link in the description where we track income ETF developments like this in real time. This is Dividend Desk. We will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial, investment, or tax advice. Dividend Desk is not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions.